I believe the Fed is going to cut rates because they're concerned about the economic impact. And this could potentially trigger a stock market boom, especially in growth stocks. It would also certainly benefit Bitcoin. However, the bigger question is, how does the Fed navigate the predicament created by the fiscal policies of our government? The Fed is now staring down the barrel of a $36 to $37 trillion national deficit, which presents an enormous challenge. Cutting rates may offer short-term relief, but it doesn't solve the underlying issue of mounting debt. The deficit has reached a level where managing it becomes increasingly difficult, and the Fed is essentially stuck in a delicate balancing act. Lowering rates could stimulate economic growth and offer temporary support for financial markets, but it also risks fueling further inflation and making the debt burden even harder to manage over the long term. The Fed is in a tough position, having to balance the immediate need to stabilize the economy with the long-term implications of an ever-growing deficit. Without significant fiscal reforms, the Fed's ability to maneuver is limited.
I believe the Fed is going to cut rates driven by concerns over the economy. This move could trigger a boom in the stock market, particularly in growth stocks, and would certainly benefit Bitcoin as well. However, there's a much larger issue at play. How does the Fed manage the situation that's been created by the fiscal policies of our government? With a national deficit approaching $36 to $37 trillion, the Fed is facing an enormous challenge that cuts far deeper than just managing interest rates. Cutting rates might provide some short-term relief by boosting economic growth and offering temporary support to financial markets, but it doesn't address the root of the problem, our escalating national debt. As the deficit balloons to unprecedented levels, it becomes increasingly difficult to manage, putting the Fed in a precarious position. Lower rates could spur growth and reinvigorate markets, but they also run the risk of exacerbating inflation, further complicating the debt situation. The Fed finds itself in a delicate balancing act. On one hand, there's the immediate need to stabilize the economy and support financial markets. On the other, there's the looming reality of an ever-growing deficit that threatens the long-term stability of the financial system. The fiscal policies that have led to this massive deficit have limited the Fed's options, essentially tying their hands. They're forced to navigate between supporting growth and avoiding a debt crisis, all while inflation pressures and global uncertainties persist. The real issue here is that the Fed cannot solve this problem on its own. Without significant fiscal reforms, the central bank's ability to maneuver will remain constrained. The deficit is just a number. It's a structural issue that requires coordination between monetary and fiscal policy. Until these underlying issues are addressed, the Fed will continue to be in a position where there are no easy solutions.
Subscribe our channel and press the bell button to get our video notification. And like the video.
Bitcoin isn't just another tech asset. It should be valued as a distinct asset class. It's not going to be traded at the market capitalization of companies like Nvidia or Apple. Instead, Bitcoin should be compared to gold, and I would argue it's even better than gold. This suggests that Bitcoin will likely trade at a market capitalization higher than gold. There are already signs of this institutional shift. For example, the mayor of Jersey City just announced a 2% allocation of their pension fund into Bitcoin, and the state of Wisconsin recently revealed a $150 million investment in Bitcoin. Next year, someone will be on stage explaining how tactical asset allocation models for institutional investors will include a 1%, 2%, or even 3% exposure to Bitcoin. When you consider the scale of these movements, it becomes hard to see how Bitcoin doesn't eventually reach the market capitalization of gold. As more institutional investors allocate even small percentages of their portfolios to Bitcoin, the asset class will continue to grow, solidifying its role as a core part of the global financial system.
Bitcoin isn't just another tech stock, it's a unique asset class that shouldn't be compared to the market capitalizations of companies like Nvidia or Apple. Instead, it should be valued against something much larger, like gold. In fact, I would argue that Bitcoin is even better than gold, which suggests that it could eventually trade at a market capitalization higher than gold's. We are already starting to see this shift in institutional thinking. For example, the mayor of Jersey City recently announced a 2% allocation of their pension fund into Bitcoin, signaling the beginning of institutional adoption. The state of Wisconsin also made headlines, revealing a $150 million Bitcoin investment just a couple of months ago. This trend is gaining momentum, and it's only a matter of time before more institutions follow suit. Next year, I believe we'll see discussions on how tactical asset allocation models for institutional investors include a 1%, 2%, or even 3% exposure to Bitcoin. These shifts represent a significant change in how large investors view the asset class, and as these allocations grow, so will Bitcoin's market capitalization. When you consider the magnitude of institutional investments, it's hard to see how Bitcoin doesn't eventually reach or surpass the market capitalization of gold. Even small percentages allocated to Bitcoin by pension funds, endowments, and other institutional portfolios could dramatically increase the overall demand for the asset, further solidifying its place as a core component of the global financial system.
For those of us who hold Bitcoin and believe in the long-term potential of digital assets, it's crucial that we approach regulation in a bipartisan manner. We want regulations that are not only favorable but also have broad support across the political spectrum. It's important that both sides of the aisle come together to create a regulatory environment that fosters growth and innovation in the digital asset space. President Trump deserves recognition for his efforts in moving the debate toward the center. His approach has helped bring people together and build a more balanced perspective on digital assets. By encouraging a bipartisan approach, he has played a significant role in shaping a regulatory framework that supports the prosperity of digital assets like Bitcoin. It's essential to continue this collaborative spirit, ensuring that regulations benefit everyone and allow for the responsible growth of the digital asset market. This unified effort will help us achieve a regulatory environment that supports innovation while protecting investors and the financial system.
For those of us who hold Bitcoin and are invested in the long-term potential of digital assets, it's essential that we advocate for a regulatory framework that is both favorable and bipartisan. The success and growth of digital assets like Bitcoin depend on creating a regulatory environment that has broad support across both political parties. We need regulations that encourage innovation while ensuring stability and protection for investors. President Trump deserves significant credit. His efforts have helped bring people from different sides of the political spectrum together, moving the discussion on digital assets toward the center. His approach has been instrumental in fostering a more balanced and constructive debate on regulation, which is crucial for the development of the digital asset market. It's vital that we maintain this spirit of bipartisan collaboration. By working together across party lines, we can create a regulatory framework that not only supports the growth of digital assets, but also addresses concerns and provides safeguards for all stakeholders involved. This unified approach will be key to ensuring that digital assets can flourish while maintaining the integrity and stability of the financial system. A regulatory environment shaped by broad-based support will be more effective in promoting innovation and protecting investors, helping digital assets reach their full potential and contribute to long-term economic prosperity.
Subscribe our channel and press the bell button to get our video notification. And like the video.